the analysis report we're looking at today argues the recent 5% dip in Opendoor stock is a major buying opportunity. It calls it a gift, actually.
Right. And the whole thesis hinges on that positive free cash flow number from Q3, the 366 million.
It's a really strong contrarian hook. So let's just dive right in and talk about how to make that argument completely airtight.
I agree. It's a compelling premise, looking past all the noise at this one key financial metric.
But for an expert audience, the first question isn't what the number is, it's where did that cash actually come from?
Exactly. And that's where we should start.
So the primary bullish catalyst, that 366 million in FCF, it needs a much deeper analysis to really prove its long-term viability.
Without that, the entire gift thesis just falls apart. It could be a one-time anomaly.
Right. The report does a great job identifying that the FCF is positive. That's a huge point. It really disrupts that old narrative that Opendoor is just a cash-burning machine.
It does, but then it gets vague. It says the cash came from selling off old inventory, leaning out the business, and that's just not enough for a sophisticated reader.
No, not at all. For anyone who really follows this space, that lack of distinction between, say, cash from real efficiency gains, the whole Opendoor 2.0 story,
and cash from just a temporary inventory liquidation.
Precisely. It creates this huge analytical gap. Are we seeing a fundamentally stronger business, or are we just watching a very successful garage sale?
And if that cash flow is mostly from clearing out old, heavily marked down homes, then the strength is completely transient.
It's a one-time event.
You can only liquidate your old stock once, and that just fundamentally weakens the gift idea because the market is smart enough to price that in next quarter.
So the core weakness here is that the sustainability isn't quantified at all.
Which means the suggestion for improvement is critical. You have to strengthen the logical support by showing how much of that FCF is repeatable.
And how much isn't.
The whole analysis has to pivot from just stating the number to actually proving the resilience of the new model.
We need proof that the new business model, the one that's supposed to be about lower volume but higher margins, is actually cash flow positive on its own.
Independent of this one-time flush of old houses. Exactly.
Okay, so let's get concrete. There are a couple of ways to do this. First, a really direct one.
Go on.
Just include a simple comparative metric. Show the change in total inventory holdings, in units or dollar value, between Q2 and Q3 of 2025.
That would be perfect. It gives you concrete evidence of just how big that old inventory sell-off was. If inventory drops, say, 40%, you can immediately deduce a huge chunk of that 366 million was a working capital release.
A one-time benefit. The analyst has to explicitly separate that from the core operational cash flow.
And if the goal is to make a real long-term value case, that the stock is cheap now because the business is fixed, then they have to go a step further.
They have to introduce normalization.
Absolutely. Normalized FCF is essential here. The iBuying sector is just so volatile. FCF is always going to swing wildly with inventory.
So the analyst needs to run that calculation. Estimate what FCF would look like if inventory levels were stable. Maybe aligned with some kind of long-term average volume.
That's a much more sophisticated adjustment. It shifts the focus away from the one-quarter surprise number and builds a much more reliable foundation for the bullish case.
Relying on that one isolated number just leaves the whole argument vulnerable. The bears will tear it apart next quarter if FCF drops. Normalizing it future-proofs the thesis.
Right. And if that normalized figure is still strong and positive, then you've actually proven that Opendoor 2.0 is solvent and profitable. Then the current valuation looks really attractive.
But if the normalized number is weak, then the report has to seriously dial back the enthusiasm.
That's right.
This kind of robust financial anchor leads us right into the second big point, which is
Structure.
Oh, I noticed that too.
The way the technical details and the huge fundamental numbers are mixed together, it's a bit jarring to read.
It really is. The report's structure it oscillates so quickly between this very precise short-term price action and these high-level metrics. It really dilutes the core thesis.
It feels like two different reports were stapled together.
Yeah. Let's look at it. It gets so meticulous on the technicals, right? It calls out the exact support range, 712 to 715, the 0.28% after-hours move.
And then, boom, you're jumping to the $5.5 billion market cap and the $962 million in liquidity.
Before landing on this purely speculative idea of a short squeeze.
It's just a structural lack of focus. It's confusing. Is this a short-term trade or is it a long-term value investment? You can't really tell what the primary driver is supposed to be.
The writer has to pick a lane.
Because that indecision, it just kills conviction.
So the analysis needs a much clearer hierarchy of evidence. The suggestion here is to establish the fundamental strength first, the FCF, the liquidity.
And then use the technicals.
Yes, use the price action as validation for when to execute the trade, not as the primary reason for the trade.
Or, if the analyst really believes the short squeeze is the main play, the to the moon part of the title, then the discussion on liquidity and book value needs to be streamlined or even removed.
Right now, they're just competing arguments.
They are. Let's assume the fundamentals are the core argument. How do we concretely connect that $7.12 technical support to the balance sheet?
You have to turn that technical floor into a valuation floor. The analysis needs to explain why the fundamentals make that specific price level so resilient.
Don't just mention the $962 million in liquidity in passing.
No, you have to link it directly. For example, state something like the 712 support is bolstered by the $962 million in liquidity, which provides a fortress balance sheet.
I like that fortress balance sheet. This cash buffer, you could say, dramatically reduces the risk of dilution and discourages prolonged bear attacks below this floor.
That's so much stronger. It transforms 712 from just a line on a chart into a real reflection of the company's capital. It shows the technicals are being driven by fundamentals.
Which is an incredibly compelling argument.
And we should apply that same thinking to the price targets. It predicts a retest of $8 and $10.
But it just relies on momentum or a short squeeze to get there. It feels weak.
Very weak. Those price targets have to be tied to specific valuation multiples.
Absolutely. If the projection is $10, it needs to say $10 represents X times our normalized FCF estimate for 2026 or something similar.
Something that brings the market cap back in line with the new, leaner OpenDOor 2.0 model. It keeps the whole thing internally consistent.
Okay, perfect. So we've fortified the main catalyst. We've refined the structure. Now we have to address the elephants in the room.
The negative metrics that the report kind of acknowledges, but then just dismisses.
This is so key for credibility. The analysis correctly identifies the two big bear arguments. The revenue drop, down 33%.
And the consistent EPS miss, a loss of 8 cents per share.
And the current approach is to just divert attention to the FCF, to basically say, these are the numbers the bears are hiding.
Which is not a strategy. To really maximize conviction, the report has to neutralize these negatives head on. You can't just wish them away.
For any serious analyst reading this, ignoring a 33% revenue drop or a consistent loss immediately creates skepticism.
Even with a strong FCF number.
You have to address the counterarguments directly and actually integrate them into the bull thesis.
So the suggestion is to refocus the narrative. Reframe that revenue reduction as a strategic success.
Make it compatible with the OpenDOor 2.0 story.
Exactly. If the strategy is leaning out the business, then the drop in volume and revenue has to be presented as a deliberate, value-creating choice, not a weakness.
So how do you prove that? How do you prove that shrinking is actually good?
You have to bring in supporting data. If possible, show that the drop in revenue correlates with, say, a big increase in the average profit margin per unit, or a reduction in inventory risk. That's the pivot. It transforms the metric from a negative, the business is shrinking, into a huge positive, the business is prioritizing profitability.
For instance, a concrete way to reframe it would be to state, the 33% revenue drop confirms the strategic shift to higher quality inventory, implying improved profitability per transaction. This reduction is a feature, not a bug.
That takes the bear's main weapon and turns it right back on them. I love that.
It's a much more powerful framing.
So let's do the same thing for the other headwind, that consistent EPS miss. Why should the reader care more about FCF than the net loss?
This is where you have to talk about gap noise. The analyst needs to address that EPS miss by attributing it clearly to non-cash expenses. Things like depreciation, amortization.
Maybe some legacy restructuring charges?
Potentially. The point is to create effectively a cash-only version of the income statement for the reader, just to clarify what's happening in the core operation.
So by isolating those non-cash items, you can strengthen the argument that the operating cash flow is the true indicator of health.
Exactly. You're setting it apart from the noise that GAAP accounting can sometimes create.
That level of detail shows a real command of the financials. It gives an intellectual justification for prioritizing free cash flow over EPS in the specific case.
You have to walk the reader through it. Show the difference between, say, adjusted EBITDA and the reported net loss.
And if they can show that cash flow strength is real, even after you discount the inventory sale, and that the net loss is mostly non-cash charges,
then you've built an airtight case for why this dip is in fact a gift.
This has been a really deep dive. I think it shows how to take a very compelling, contrarian report and just maximize its impact.
The foundation is excellent. The analysis